What if you could unlock an extra $1 million in your borrowing capacity from the bank? Not by having a once-in-a-generation season, but by understanding one simple secret. Banks don't lend on loyalty, they lend on policy. Most farmers will walk into a bank and ask, "How much will you lend me?" And they get a conservative number based on a fraction of their true potential. The bank isn't going to show you how to maximize your position. They won't tell you that your tax structure is strangling your serviceability, or that their competitors have a policy that's perfect for your operation. They'll just give you their number, but there's a way to get a better number. Today, I'm going to show you how to find that extra $1 million. We'll cover the key loan drivers, the silent killers of your borrowing power, and how to present your business so the bank has no choice but to say yes. This isn't about selling your soul. It's about finally learning the rules of the game. Welcome to Dollars in the Dirt. I'm Brecken Curtis, and this is where we break down the finance side of farming so you can grow your operation, buy that next property, and build real wealth. Let's get into it. So first and foremost, you need to have a clear plan. How your business is positioned and presented makes a massive difference, especially in agriculture. We all know agriculture is complicated. We have varying seasons, varying geographical locations, varying commodities. Every property is different, and no two businesses are exactly the same. And that's why you have to have everything presented in a way that makes sense to the bank. Everything needs to be up to date. Your financials, your ATO commitments, your livestock numbers, and your valuations. Banks lend on policy and risk, not on history or loyalty. And that's why it's really important to make sure that you're working with the bank that understands your business and not just a bank that you've been loyal to for years. Most of the time, it shouldn't be a no. It's like, if we can change this or do something else, then this is how we can do it. And a bank manager isn't going to tell you that. And by having a finance broker or someone that understands the rural business, it's in your corner. It's really important to be able to paint your picture of your business, where you want to take it, and having a clear plan with your numbers, your budgets, your forecasts, and your livestock schedules to say, this is where my business is and this is where I want to take it. You also need to know who to talk to. If you get a banker that's not proactive or keen to do business with, it'll cost you a fortune. We see this all the time. You know, people come to us and they say, well, I've spoken to my bank manager, but he didn't seem very interested in us buying the property next door or buying that property a couple hundred kilometres away that will help us with spreading our risk around geographical location and drought risk and that sort of thing. So if the bank manager's, not keen to lend money, or, maybe I've seen it all the time where they're close to retirement and they're not that interested in actually having to do the work to put the application together. At the end of the day, the bank manager's still going to get paid his wages, whether he gives you the money or he doesn't. So you need to make sure that you're working with the right people that understand your business, understand where you want to take it, and really invested in making sure they get the right outcome for you and helping you grow your business. You also need to have it mapped out before you apply in your own mind. So making sure that when you go and have that meeting with your finance broker or your bank manager, that you understand where you want to take your business. You've actually sat down, done the numbers, shown that you can make it work on paper, that your business can handle the extra debt, the income that you're going to generate from that business, what it's going to look like. If you're sort of relying on your bank manager to actually put all that together for you, that's going to make it harder for them and harder for you to know where you stand, because they're not going to say, if we change the way that these numbers look in this way, it's going to give you the ability to borrow a bit more money. They're not allowed to do that. So making sure that you've mapped it out in your own head, that you can clearly articulate your plan and where your business is heading, and being able to present that in a professional way and not scrambling, when an opportunity arises. We see it all the time. People come in and they say, the next door neighbour's properties come for sale, and how can you help me get the money together? But their financials aren't sorted, their ATO's not up to date, they don't know what their current livestock numbers are, they don't know what their current valuation is on their property. You need to make sure that you're prepared and make the most of those opportunities as soon as they arise. But if we spend 2 weeks trying to get all the information together, it will make it hard to be able to act quickly and to be able to make the most of the opportunities and make them happen quickly. I'm going to get a bit technical here, but it's really important that we understand the key loan drivers. And we talk about the 3 C's of credit whenever you go for a loan, and that's character, capacity, and collateral. And, if you understand those key drivers when you go and apply for a loan, it gives you the best opportunity to do that. Good tax advice often can hurt borrowing capacity if it's not managed effectively. If you get the right advice around that, it's really important that the structure is set up early and set up correctly. Understanding what the drivers are in your financial statements, depreciation, one-off purchases, how that's treated, how your owner salaries are treated by the bank. By really understanding the numbers and the financials, it puts you in a lot better position to be able to borrow the money. Timing of income, often people defer livestock sales or commodity income to fix a tax planning problem. This can often make your financials not look as effective as what they should. The next year, you might be looking to expand your business, but you might have made a loss in the previous year. Because that was the advice that you were given, and you delayed the sales of some cattle, but that might then impact your ability to borrow the money when the opportunity arises. So it's really important that you think about, if I'm looking to borrow a property, buy a property in the next little while, what my financial statements show and the picture that paints of my business. So the other thing is around security. So understanding that different banks have different policies around loan to valuation ratios. And when we talk about loan to valuation ratios, what we're talking about there is how much security you've got and how much the loan is. And so different banks look at different properties and what they'll lend different amounts of money against the same property. So one bank might, if you've got $1 million property, they might lend you $600,000 against that, where another bank might lend you $700,000 and others might only lend you $500,000. So each bank has a different policy, and by skipping the broker and going directly to the bank, you're only getting one bank's view on that policy. So it's really important that you understand how the LVR works and that different banks have different policies, so that when you're applying for a loan, if your bank says, oh, you don't have enough security, well, there might be another bank next door that has a different policy that will lend you a bit more money. And that might be the difference between buying the property and not. And how banks view your security is different too. Like different asset classes have different views in terms of the bank's credit policies. So if you have a rural property in a certain location, one bank might, consider that acceptable security, where another. So if you've been with one bank for a long time and you go in there and ask for a loan, well, if they don't like that postcode or like that location of that property, they mightn't give you the money, where another bank will. The other thing that's really important is around structuring, how assets are owned and how your trading entity's set up. A broker will help you with understanding and navigating that with a bank, whereas a bank manager will just assess what they're given. So having a broker working for you, understanding, if I've got a company set up or a trust set up, and how that works when you go to borrow money, and how that impacts on being a guarantor and who the guarantors are going to be, is really important. So if you skip a broker and just go directly to the bank, the bank manager isn't traditionally going to give you advice around the structure. They're only going to assess what they're given and presented in front of them. Just quickly, if you're tired of explaining your operation to a new bank manager every year, only to get a one-size-fits-all deal that doesn't fit your business, we can help. At Seasoned Finance, we do things differently. We've got over 70 years of combined experience in agricultural lending, and we work for you, not the banks. We're the consistent expert team in your corner, fighting to get the finance that actually helps you grow, purchase the next property, and build your legacy. Don't leave money on the table. If you're looking at your next move or just want a second opinion on your current setup, click the link in the show notes to book a confidential, no obligation chat with the team, and we'll show you what's possible. Righto guys, now back to the episode. The other thing that's really important is around how the business is structured, is around separating, your land holding entities from your trading entities, understanding if there's litigation risk and, an asset protection, succession. It's really important that people start out in ag, if they have off-farm businesses, and how that cash flow will impact and assist them with growing their business or buying a property, and also considering, what litigation risk there is with off-farm businesses and how you protect the assets that you might buy, and having that structure really set up in a robust and thought out way makes it really important for the customer when trying to protect assets and also transfer them to the next generation. Now that you understand the core fundamentals of the things that you need to know, the other thing that really is important is that bank choice matters more than you think, and different banks have different policies on how they treat things like livestock trading. One bank mightn't view livestock trading as a way they prefer breeding, or they don't. And the other thing they might look at is agistment. Different banks have different policies around how they view agistment income. Off-farm income is also considered differently from different banks. So it's really important. If you skip the broker and go to one bank, you're only going to get one view on how those different sources of income are viewed by that bank. And that might be the difference between you being able to secure a loan or not. So A broker will be able to put you with the bank that actually accepts agistment as income, or accepts livestock trading as income, or accepts your off-farm income in the servicing capacity of the business. So it's really important that you understand a banker will only assess that on the policy that they have in front of them, where a broker has access to the multiple funders that have all different policies. The other thing that's often important to understand too is that different banks have different concentration risks around different locations, different industries, different commodities. Often, a bank might have too much exposure in one commodity. And this is why it's really important that you work with a broker to be able to look at the different options and the multiple lenders if required. Because as I've said, there's different idiosyncrasies with each different bank that if you just walk into one bank, you're going to get their view on the world. Where if you go to a broker, you're getting multiple views across different industries, different locations. But even with the right bank and the right broker, there are hidden factors that can silently destroy your borrowing capacity, and things that most farmers don't even realize are working against them until it's too late. And some of these silent killers of your borrowing power are over-aggressive tax minimization. Often, especially in the rural industry, people don't often like to pay tax, which is fair enough, but does that impact your ability to borrow more money, to buy the next door farm, which will actually make you more money in the long term? By being too aggressive on the tax minimization can often be a big handbrake on being able to buy a property or expand your business in the future, and not reviewing old debt facilities as well is, they're on outdated interest rates. If they weren't reviewed and restructured, often there's rate creep there where the rates have slowly gone up over time. And what that does is you might have a loan sitting over there that's on a higher interest rate, but if it was restructured or refinanced, it would have been a lot better rate. Then that gives you the ability to borrow a bit more money as well. The other thing there's often is, personal debt, that's taken into account in the serviceability analysis if the structure's set up that way. So understanding, if you've got personal debts over here, what impact that might have on your business and be able to borrow more money on the farm. The other big thing is, we've said it time and time again, but is the poor presentation of financial information. Even when your numbers are good, and if it's not presented well or things aren't up to date, that can often, paint a bad picture and often inhibit your ability to borrow more money. And not telling the bank the story behind the numbers, if there's a drought or, something happened in the business or there was a flood, you need to be able to tell what happened in those years. The reality is that there'll be ups and downs in your income, and it's not like a commercial business where there's consistency every year around sales. And, a rural business has big years, small years, and there's all sorts of things that happen from a tax point of view with deferred livestock sales and, farm management deposits that need to be taken into account. And you need to be able to paint that story to the bank around, what happened in that year and understand exactly what your accountant does with your financials so that when you go to borrow money, you're prepared and you present your business in a professional way and understand the numbers. And now here's the critical distinction I need you to know. Just because you can borrow the extra $1 million doesn't mean you should. And being able to borrow an additional $1 million doesn't mean that you should always do it. And debt that improves productivity versus lifestyle debt, you need to be really careful that you don't end up with debts that this farm or the business is having to service that aren't productive to the farm or, making it grow or stronger. So just because you can go and borrow more money to do things doesn't mean you always should. And the other thing that you should also look at is also stress testing for, interest rate rises, input cost spikes, and seasonal shocks. There's always something that comes out of left field with a farming operation. And when you run your numbers, make sure that you do different scenarios. If there's a 20% reduction in the commodity price, what does that mean? Or a 10% increase in input costs, what does that mean to the business? And, if it doesn't rain next year, what does that look like? So all those scenarios need to be taken into account, and having someone to help you put that together is really important. So here's my challenge to you. Stop accepting the first number that your bank gives you. Stop assuming that because you've been loyal to one bank for 40 years that they're giving you the best offer. Stop thinking that your tax accountant advice and your finance strategy are the same thing, because they're not. The extra $1 million in borrowing capacity I've been talking about, it's not hypothetical. I see it every single week. A farmer comes to us after being knocked back by their bank or after accepting a conservative offer, and we show them how they can unlock an extra 30, 40, sometimes 50% more capacity just by changing how the deal is structured and which bank they approach. That's not magic. That's not luck. It's the understanding the system and knowing how to work in your favor. You now have a framework: clean numbers, clean plan, right structure, right bank, and right representation. And the question is, are you going to apply them? Because the farms that are securing the best deals right now aren't waiting for the bank to come to them. They're not hoping loyalty will carry them through. They're being strategic, they're being prepared, and they're working with people who understand both sides of the table. If you want to talk about your position, your operation, and maximizing your borrowing capacity, or if you just want a second opinion on whether you're leaving money on the table, reach out. That's what we're here for. Because at the end of the day, the difference between a good deal and a great deal can be the difference between staying where you are or buying in block next door. Thanks for tuning in to Dollars in the Dirt. If you've got value from today's episode, make sure to subscribe so you never miss the insights you need to grow your business. And if you're ready to stop being just another number to the banks, visit Season Finance via the link in the show notes. Remember to follow us on socials, and catch you next time.